Hello, and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, July 14th, and I'm recording this from the field in Denver, Colorado. A couple of weeks into the third quarter, and U.S. equities are up more than 6% year-to-date, sitting just below all-time highs, as markets once again seem to be anchored to a Goldilocks thesis. This new bullish narrative seems to dismiss concerns about growth and inflation in favor of an enthusiastic embrace of corporate tax cuts as bringing forth a boom in CapEx and productivity. There's also hope that inflationary forces are fading enough to reignite a Fed easing cycle and that regulatory reforms and stablecoins could mitigate pressures from surging debts and deficits. To be sure, the S&P 500 may have a bit more room to run, moving towards Morgan Stanley & Co.'s 6,500 target price, helped along by technical and positioning factors. That said, our enthusiasm around the bull case in 2026 remains more muted. For starters, there's the bond market disconnect. While equities seem to be dismissing inflation threats from tariffs, bond markets suggest that trade taxes do remain a risk. Specifically, inflation swaps are pricing a rise in inflation over the next 12 months from tariffs to 3.3%. Meanwhile, the U.S. dollar has depreciated 11% since January, and a weaker dollar will only magnify these tariff impacts. Likewise, on growth, treasuries do not appear to embrace the reacceleration narrative that equities seem to be holding on to. Since the passage of the One Big Beautiful Bill Act, 10-year real rates have stayed anchored around 2% in a tight range that they've traded at since last Halloween. Also, the 10-year term premiums have been consistently expanding since Election Day and are now up 15 basis points since the tax bill's passage. This reflects genuine demand for compensation for the future risk of debt sustainability. Beyond these bond market dynamics, we also question predictions of a CapEx-driven productivity boom that will drive margin gains. Certainly, spending related to generative AI has been strong and may continue for some time. But this trend, we believe, has long been priced, and new tax incentives will add little incrementally. Also, whether the new tax law will actually stimulate additional CapEx is in question, given that capital spending has already been extremely strong since 2021. And beyond the fact that historically there's been little correlation between CapEx and effective tax rates, we question whether much of the CapEx gained is simply being offset or paid for by canceling clean energy and infrastructure projects passed under the previous legislation. Finally, taking advantage of bonus depreciation and R&D expensing actually reduces operating margins, translating tax breaks into one-time gains in cash flow and net income, but not necessarily improving corporate efficiency. So at this time, with continued policy uncertainty and compressed equity risk premiums, we prefer listening to the bond market and being stock pickers. It's time to contain our enthusiasm and re-anchor to reality as opposed to the best possible case. Consider stocks with potential for upside earnings surprise and cash flow among select tech names and others in financials, industrials, energy, and parts of healthcare that are policy beneficiaries. But avoid the overhyped themes and look to complement all of this with diversifying positions in international equities, commodities, energy infrastructure, and hedge funds. Thanks for listening, and for more information on portfolio strategies and financial planning, as always, please reach out to your Morgan Stanley financial advisor.